Welcome back to Investing Talk podcast.
Good to be back.
Today, we're focusing on PulteGroup, a major player in the U.S. homebuilding industry. We've got quite a bit of material here, a due diligence report, company overview, recent analysis, all current as of April 2025.
Right. And our goal is really to unpack what's most important for you, the listener, to understand about PulteGroup right now.
We'll be covering their Q1 2025 financials, the competitive scene, industry trends, you name it.
And maybe touch on what might shape their future.
Okay, let's get started. Where should we begin? The Q1 numbers.
Sounds good. So for the first quarter of 2025, PulteGroup reported net income of $523 million. That works out to $2.57 per share.
Okay, $2.57 per share. And how does that compare? I recall Q1 2024 was higher.
It was, yes, $3.10 per share back in Q1 24. But it's important to remember that figure included some one-time gains. So not quite an apples-to-apples comparison on the surface.
Got it. So the underlying performance might be more stable than that headline drop suggests?
Potentially, yes. And interestingly, the CEO mentioned buyers started responding more when interest rates dipped late in Q1 25.
So that sensitivity to rates is definitely visible. What else stood out in Q1?
Well, home sale revenues were substantial, $3.7 billion. That came from closing 6,583 homes.
$3.7 billion, and their margins, how did those look?
Pretty solid, actually. Home sale gross margin was 27.5%. That's quite healthy.
That is strong. What about new business coming in?
Net new orders looked good, too. They signed contracts for 7,765 homes, minus cancellations, of course. And the value of those orders, about $4.5 billion.
So demand seems pretty resilient then.
It seems so. And their backlog reinforces that. They ended the quarter with a unit backlog of 11,335 homes.
And the value on that backlog?
$7.2 billion. So that gives them some visibility into future revenues, you know?
Definitely. And I saw they were also active buying back shares.
They were. They repurchased $300 million of their common stock during the quarter.
Which, as you mentioned, signals management's confidence.
Right. Confidence in the company's value. It also helps boost earnings per share, obviously. But it does mean that $300 million wasn't used for, say, paying down debt or snapping up more land immediately. It's a trade-off.
A capital allocation choice.
Right.
And cash position, how did they end the quarter?
Pretty strong. They had $1.3 billion in cash on hand.
Okay, that gives them flexibility.
A good cushion, yeah. For investments or just navigating whatever the market throws at them.
Yeah, let's maybe unpack what the CEO, Ryan Marshall, was saying. You mentioned the rate sensitivity, but he also talked about affordability, right?
I did. He highlighted that affordability is still a major challenge.
Yeah.
Even with those rate dips late in the quarter, you know, high home prices combined with mortgage rates still sitting around, what, 6-7% back then? That's tough for buyers.
It really puts pressure on them, doesn't it? Trying to find that sweet spot.
Absolutely. It's a balancing act. How much can you push price versus needing to keep sales moving the pace, right? Marshall's comments show they're very focused on managing that.
So their strategy is about finding that balance to deliver, as they put it, high returns.
Exactly. It's about managing price, managing costs, being disciplined, but also continuing to return capital to shareholders through those buybacks while still investing in the business land acquisition, community development.
It sounds like a mature approach, not just chasing volume, but focusing on profitability and shareholder returns.
I think that's a fair assessment.
For listeners who might not know PulteGroup as well, they're not new to the game.
Oh, definitely not. Been around over 70 years. And they're huge. The third largest home builder in the U.S.
And they operate under several different brand names, don't they?
They do. That's one of their key characteristics. You
Yeah.
got Centex, Pulte Homes itself, Del Webb, DeVosta, John Whelan Homes and Neighborhoods, and American West.
Quite a portfolio. And they target different types of buyers.
Right. Centex often goes after first-time buyers. Pulte Homes is more for the move-up market. And then Del Webb and DeVosta are really well known for the active adult communities, you know, the 55-plus demographic.
That diversification seems like a real advantage, catering to different life stages and price points.
It is. It helps insulate them somewhat if one particular segment slows down. Plus, they're geographically diverse, too, operating in 24 states, over 45 major markets.
So, okay, we understand PulteGroup's recent performance, their strategy, their structure. How do they fit into the wider competitive landscape? Who are they up against?
Well, the two big ones ahead of them are D.R. Horton, that's the largest, and Lennar Corporation, number 2.
And how do they differentiate? Do they all just build houses?
Well, yes, but they have different approaches. D.R. Horton is known for its sheer scale and broad product range. Lennar has put a lot of emphasis on technology, and the customer experience side of things.
And PulteGroup, as we've discussed, seems to really lean on that brand diversification and the focus on high returns.
That seems to be their strategic angle, yes.
Yeah.
Leveraging those distinct brands to capture specific market segments effectively.
Makes sense. Now, stepping back to the whole industry, what are the big trends affecting builders like PulteGroup?
Well, on the one hand, there's still strong underlying demand. Most analysts agree there's a structural shortage of housing in the U.S.
But there's always a but.
But, as we keep saying, affordability is the big counterweight. Economic uncertainty doesn't help either. And interest rates, they're just a huge driver.
We saw that in their Q1 results, right? That little dip in rates seemed to immediately boost buyer interest.
Exactly. It highlights just how sensitive buyers are to those monthly payments. Any shift in rates gets noticed fast.
And what about other risks, beyond rates and affordability?
The usual suspects for builders, really. Potential regulatory holdups, permits, zoning, supply chain disruptions, though maybe less acute than a year or two ago, and land inflation. Finding good parcels at reasonable prices is always a challenge.
Okay, so let's try to sum up. What are PulteGroup's core strengths based on this info?
I'd say first, that diversified portfolio of brands and customer segments, that's key. Second, their track record consistently delivering pretty strong revenues and margins.
Their cash flow management seems solid too, with the buybacks.
Yes, effective capital allocation. And then opportunities. Potential to gain share, particularly with Centex maybe grabbing entry-level buyers squeezed by affordability, or Del Webb capturing more of that growing active adult market.
Plus the land they already have banked for the future.
Right, strategic land banking.
Okay, now for the flip side, what are the main risks or maybe red flags we should keep in mind?
Well, the housing market itself is just inherently cyclical and volatile. That's always risk number one. Demand and pricing can change.
And the competition is fierce.
Very. Having D.R. Horton and Lennar ahead of you means constant pressure. And of course, the risk that interest rates stay high or even go higher, further eroding affordability, that's probably the biggest near-term cloud.
Regulatory delays too, you mentioned?
Yeah, anything that slows down development adds cost and uncertainty.
How are analysts generally viewing them right now based on this info?
It seems the management's focus on high returns and maintaining that strong liquidity position is seen pretty positively, especially compared to, say, smaller builders who might be more leveraged or have less financial flexibility.
And the fact that Q1 earnings, when adjusted, beat the prior year probably helped sentiment.
Likely did, yes.
Mm-hmm.
And notably, there wasn't any significantly negative forward-looking guidance mentioned, which suggests they feel relatively stable despite those broader market pressures.
Okay, last point. Valuation. We don't have specific ratios here, but what factors might influence how the market values PulteGroup?
Well, things like their strong cash flow, the share buybacks, their operational scale, those could argue for a premium valuation compared to some peers, especially if interest rates were to stabilize or start coming down. Consistent profits and that big backlog also help.
But the big if is the economy, right?
Absolutely. If we see prolonged inflation or if recession risks become more serious, that could really hit buyer demand hard, and that would obviously impact their valuation negatively.
So let's try to tie this all together. PulteGroup seems to have navigated Q1 2025 with a disciplined strategy.
Yeah, they managed to post solid results despite the challenging housing environment. Those diverse brands and the focus on profitability appear to be serving them well.
But the whole sector is just so tied to the bigger economic picture.
Incredibly sensitive. Interest rates, affordability, those are the key things to watch. There's demand out there, no doubt, but converting that demand depends heavily on those factors.
So anyone following PulteGroup needs to keep a close eye on rate trends and general housing market news in the coming quarters.
Definitely.
And remember, this conversation was based on the information available up to April 2025. For the absolute latest, you should always check PulteGroup's own investor relations materials and their SEC filings.
Good point. Things can change quickly.
Well, that wraps up our look at PulteGroup for today. If you found this analysis helpful, please do subscribe, like, and maybe leave us a comment. It really helps us understand what insights you're looking for.
We appreciate you tuning in.
Thanks for joining us, and we'll catch you next time on Investing Talk Podcast.